Well, good afternoon and welcome everyone to our weekly webinar where we'll talk about what we see happening in the global economy, financial markets, and the world of wealth management and how all of this impacts our decisions on the best courses of action for our investment strategies. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. My name is Scott Tomlinson and I'm joined on the call by my partner and colleague Paul Tepsich, the founder of High Rock, and our financial planner, Bianca Tomlinson, is also on the call. We will have a question and answer period at the end of the call, so if anyone has a question about any aspect of wealth management, we invite you to feel free to ask questions. Remember, if you have a question, it's likely that other listeners may have the same questions, so we do encourage you to engage us. Now, based on some excellent feedback from our listeners in the past, we've made some adjustments to the format of our weekly call. If you are a first-time listener and would like a little more information about our private client services and our philosophy of transparency, we have a separate webinar that will provide you with this on our website adjacent to this weekly webinar. Okay, well, each week we return to our 2015 themes, and the overriding theme this year has been to expect the unexpected. So let's briefly recap the first 3 quarters of 2015. At the beginning of the year, not too many expected oil price and other commodity price declines to push Canada into a mild recession. We certainly did not expect the Bank of Canada to lower the overnight rate twice. Well, when the unexpected occurs, financial markets get volatile, and volatility reduces confidence. When people are not confident, economic decisions are postponed, consumers don't consume, producers don't produce, and economic growth deteriorates. So what was an optimistic U.S. Federal Reserve became a concerned U.S. Federal Reserve. And it happened also at the Bank of England. Now, the European Central Bank continued to stimulate the euro area economy with unprecedented levels of quantitative easing, as did the Bank of Japan. And when the Chinese equity market started to unwind, the Bank of China acted with stimulus and buying support. And as I mentioned earlier, the Bank of Canada cut rates twice. The U.S. economy was expected to show robust second half growth, but the global economy, especially deteriorating emerging market economies, appear to be creating headwinds and uncertainty here as well. U.S. GDP was better in the second quarter at a better than expected 3.9% rate of growth. However, third quarter expectations are coming in at a more subdued 2% level. The manufacturing sector is struggling. Employment growth has slipped. We will see September's data on Friday of this week. And the labor force participation rate remains at levels not seen since the late 1970s, early 1980s. Now, 2/3 of the U.S. economy is dependent on the consumer, but the baby boomers are saving for retirement and the millennials have less money to spend. Wage growth is relatively stagnant, and while the consumer is confident, they're just not following through with spending, except on automobiles, which are financed with record low interest rates, restaurants, and increases in rent. Meanwhile, on the inflation front, the global central bank's core mandate is price stability. Most have a target of 2% for core inflation. Well, commodity prices continue to make new lows, and this is reflected in declining core inflation in the U.S. The consumer consumption expenditures price index still well below the U.S. Fed's target. In the euro area, still well below target. Same in the UK. And the latest data showed Japan actually slipping back into deflation with less than 0% inflation. A couple of weeks ago, before the Fed's interest rate decision was announced, we also talked about the increase in global debt. And we've talked about the debt levels of developing economies and in Canada with record household debt to income levels. Now, credit conditions have already been tightening. Lenders are demanding greater security. Borrowing is becoming more expensive, especially for those who have U.S. dollar debt. So if the Fed were to raise rates, borrowers will definitely be hit harder. This would put the already struggling global economic growth into greater headwinds. Now, financial markets take their cues from bond markets, and bond markets continue to tell us that inflation expectations are low because the prospects for economic growth continue to be low. And in the case of some German short-term bonds, there is real concern about deflation, which has driven safe government bonds into negative yields. They also tell us that, at least for the time being, interest rates are likely not going higher. Before equity markets turned lower in August, we pointed out at that time on this call that high-yield bonds tend to lead equity markets. Well, equity markets fell heavily shortly thereafter. We're seeing high yield, the orange line, dip again now, and Paul tells me that the markets there have got rather illiquid quite recently. So we're monitoring that situation closely, but it also may mean that U.S. equity markets and the S&P 500 are ready to turn lower, and again, something we want to be very conscious of. Low interest rates and low returns on bond investments have forced investors to take greater risk in search of better returns, and they had driven equity markets to new highs. And with apologies for being repetitive, but we have been quite vocal since last April with our opinion that stocks were expensive. Now, the 10-year average price to earnings ratio is 14.1. Currently, the forward 12-month average is 15.1. Now, this compares with a level of 17 last May. So it does tell us that stocks are still expensive, but they have been getting cheaper. And we're getting into earnings season for the third quarter. Earnings for the second quarter declined, and it's likely, and it is expected that earnings for the third quarter will also decline, and the number is approximately 4%. Now, this would be the first back-to-back quarterly earnings decline since 2009. Also, enterprise value to EBITDA, another good measure of current S&P 500 company value, shows equity prices to still be rather expensive. On another measure, investors who borrow to buy equities, otherwise known as using leverage, they're okay until they start to see the value of the collateral that they have declined. When asset prices drop, lenders either want more margin or they want the borrowers to pay down their debt, which means that the borrowers need to raise cash. Now, they can do this by selling assets, and in some cases, they may sell the most profitable assets that they own. In some cases, just the most liquid assets, so they can have easy access to cash. But this selling increases volatility and, of course, uncertainty. Historically, a decline in margin debt leads equity prices lower. After record levels of margin debt earlier this year, we could be seeing similar margin-related equity selling coming, if not already, very shortly. Well, S&P 500 prices were driven to record highs in May of this year, certainly by low interest rates and share buybacks. But at High Rock, we've been telling our clients and anybody who would listen that this was overdone. Now, since their highs, the S&P 500 is lower by about 11.5%. And fundamentally, while they've been getting cheaper, we still think that they're relatively expensive, and we would not be surprised to see the S&P 500 fall by close to 20% from its highs. Well, as portfolio managers, and I've talked about this regularly, we have a long-term perspective. We believe that markets are cyclical. We are well off the recent cyclical highs for equity markets. However, it is not exactly clear how far into the cyclical downturn we've moved. So we're watching closely as how markets are behaving. Now, it's not necessarily about the economy, but about the perception of what will happen next. And that's where our understanding of behavioral finance enters the equation. We need to determine the current psychology of the market and look for the buying opportunities when they present themselves. Now, I know I say this every week, but with low economic growth, low earnings, low commodity prices, low inflation, and low interest rates, we're going to continue to be in a low return environment, and investors will need to continue to adjust their expectations, at least for the foreseeable future. And as always, we need to stay focused on risk-adjusted returns and not be driven to chase higher returns at the expense of adding risk to our portfolios. Now, we had a request a couple of weeks ago to talk in a little more detail about the composition of our portfolio models. I discussed these last week, but I thought I might go through it again this week just to give further clarity. Now, we have three models with which to build our balanced portfolios. Our fixed income model is comprised of four sub-asset classes. The AAA government bonds that are the safest asset that we can own. They are a hedge against deflation and temporarily are able to offset any short-term spikes of equity market volatility. High-quality corporate investment-grade bonds also protect against deflation and add yield to the average bond return. Now, we often talk on this call about the excellent risk-adjusted returns of high-yield bonds that are not necessarily correlated to interest rate movements like other bonds. We like that diversification and have a dedicated allocation to them. Finally, we like the tax efficiency of dividends, and we can get these from fixed rate perpetual preferred shares. Now, we only buy the best quality financial institutions and avoid the fixed reset preferred shares that have lower yields and shorter maturity horizons. Now, speaking about preferred shares, I wrote this morning in my almost daily blog about the anomaly developing in the perpetual preferred share market that is taking these issues to the best levels since 2008. To briefly recap this, there's been a large seller or sellers of a Canadian preferred share index ETF, and they've been in the market. And I'm told that this may be a computer-generated selling. So in a market that is less liquid, this can have a fairly profound impact on prices because the computers don't really care about price, and some real opportunities may develop here. However, we need to be careful to pick our spots because this selling can continue for a while longer. And again, there may be some tax loss selling that usually happens in the latter part of a year that may occur with some preferred shares because many of them are down over the course of the year, and there may be some losses that investors will want to use against other capital gains. So we may see some tax loss selling in the preferred share area as it comes. So we'll be monitoring this closely, but definitely watching for opportunities that may arise. Okay, now let's turn to our global equity model. Our objective here is broad diversity across many different geographical locations and economic sectors. Our approximate target weights at the moment are the following. 10% for large Canadian companies, 7% for an assortment of Canadian real estate investment trusts, 20% for large U.S. companies, 7% for mid-size U.S. companies, about 5% for small-size U.S. companies, 22% for large international non-North American companies, about 2% for small international companies, and approximately 6% for emerging market companies. The balance currently approximately 21% in cash for future buying opportunities as we see them develop. Now, remember that we buy companies and not the countries through the exchange-traded funds that we invest in, and that the percentage weights, they may change at any time if we see advantages in doing so. Now, we'll also own these ETFs in U.S. dollars or possibly have cash in U.S. dollars because when the world gets volatile, the U.S. dollar is a safe haven. And this can drive the value of the U.S. dollar higher, which reduces the impact of volatility on the portfolios. Our third model is made up of usually small to mid-sized Canadian companies that we believe through our in-depth research may have outstanding growth potential. This could hold up to 10 names and may in fact hold U.S. companies as well if we see the potential value of doing so. Now at the moment we own 3 companies in this model and the balance is in cash. Now a client portfolio, depending on their goals, objectives, risk tolerance, and their wealth forecast may strategically comprise all of or some of these models in varying degrees. Don't forget, Paul and I own the same models in different mixes. My 60% equity and 40% fixed income balance has 40% of the fixed income model, 55% of the global equity model, and 5% of the Canadian growth model. However, another client, depending on their strategy, could have a combination of 45% equity, 15% Canadian growth. Paul in his portfolio has 50% fixed income, 25% of the global equity, and a more aggressive 25% of the growth model. As well, more conservative balance could have 60% or even 70% fixed income. So again, it is really a function of clients' portfolio strategy that determines what they will have as a mix in their portfolios. Now our research shows that over time a well-balanced portfolio will give an investor better risk-adjusted returns than some of the equity indices like the S&P 500 or the TSX. Now in my portfolio, U.S. companies comprise about 18% of the 60% equity, 40% fixed income mix. Year to date, the S&P 500 is down close to 8.5%. The Canadian companies in our global model are approximately 9% of my 60-40 mix. The S&P TSX is down a little, or around 11% so far this year. The Euro area companies represent about 40% of my 60-40 portfolio. The Euro Stoxx 50 is down about 3.5% this year. Japanese companies are about 3% of my mix. The Nikkei 225 is up by approximately 1% so far this year. UK companies are about 2.5% of my 60-40 portfolio. Year to date, the FTSE 100 is down a little under 9%. And Australia represents probably less than 1% of my 60-40 mix. But year to date, the Australian All Ordinaries Index is down about 4.5%. As for China and other emerging market companies, which represent about 3% of my 60-40 mix, China's Shanghai Composite is down 4% on the year, and the emerging markets ETF that we buy for our model is down approximately 6% on the year. So by comparison, my 60-40 portfolio, which is comprised of our 3 models, is up by about 0.5% so far this year. Paul, do you want to add anything here?
Yeah, thanks, Scott. As Scott mentioned earlier, we typically, we've modeled out that we would own anywhere between 0 and 10 different Canadian stocks. And as Scott mentioned, we own about 3 right now. We are looking at a few, and we have orders in on a few, and they're below the market. We have even adjusted some of those orders lower, and they've gone through where our original orders were. So I will just highlight to people that a couple things. Number one, those 3 names that we have bought are lower, unfortunately, but such is the market. And you know, one could argue that things that we have bought are lower. That could be the signal of a bear market or a weaker market at a minimum. So we're not going to stand in and just buy things for the sake of buying them. And you know, there's no quote. Sometimes it's not what you do, but what you don't do that matters. And we don't feel that we need to be invested right now. And that's very to know. And I guess the other important thing for our clients is we're in this together. We're doing this for ourselves. So we're treating, Scott and I are treating our capital extremely cautiously right now, and that means we're treating your capital extremely cautiously right now because we're doing the same thing for all of us. That's it.
Well, thanks, Paul. That's great. I appreciate your input, and I obviously agree with all the strategies that we're taking at the moment. And I think that's fairly clear to all our clients that you know, we feel the need to be defensive at this particular point in time, and that's exactly how we're treating our portfolios, and as a result, that's how their portfolios are being treated. Okay, well, that's it for today's discussion. If anyone has a question, we're here, so please feel free to ask away. Okay. Well, no questions this week. We have had some good questions in the past couple of weeks, so I guess we're going to get a break. But please, would like to stress, if you're listening to this call on the recorded version, we'd love to get feedback on these webinars, what you like to hear, what you don't like to hear, if we're being too repetitive, anything like that. If you have questions about any of the topics that we're covering, we certainly want to be able to digress more on those. So please feel free to let us know if there's anything, and our contact information is there on the screen. But that's it for another week. Certainly want to thank you all for taking the time to be with us. Wish you a great rest of the week, fantastic weekend, and we'll return with another webinar next Tuesday. This is Scott Tomlinson signing off.